What's up everyone, Dylan here. I wanted to hop on and do another episode of the weekly analysis video. This week's episode is going to be on the shorter side, but going forward, the length of these videos are going to be totally dependent on what's going on in the market. So, with that said, we'll hop right into it. In last week's video, I covered what has been happening in the near term, right? What's been happening in the recent past. I talked about how the S&P 500 futures managed to rally 9 consecutive weeks, okay? Then, going into 2024, the first weekly candle closed red, okay? I said how this was no surprise because of the timing, okay? On one hand, you have profit taking after a 9-week rally. Another thing, you have digestion, right? Profit taking and digestion can kind of be in the same boat. Okay. I also talked about the rebalancing stage, right? Funds will tend to take profit on the equities that outperformed in the previous year, right? And they'll take those profits, right? They get better benefits with tax harvesting rules. They'll take those profits and roll them into equities that underperformed, right? Like I said, I covered that in greater detail in last week's video, okay? So what I also said was that period of pulling back tends to be short-lived, and that's exactly what occurred, right? The following week, which was last week's candle, managed to take back everything that was lost in the previous week, okay? Not only were the bulls able to break above the previous week's high, but they also managed to defend the previous week's low, okay? So basically, what I'm trying to say is we're right back to the point where the new year started, okay? So when asked the question, Dylan, what do you think the market's going to do in the near term? This is kind of where I'm leaning, okay? Obviously, I'm not always right, but if I was, I wouldn't be making this video right now. But if I had to guess, right, what my lean is, this is what we're about to go over. So when it comes to historical data such as all-time highs, I do not like to use the S&P 500 futures contract. Why? Because forward-looking contracts have built up premium, right? What I mean by that is when the S&P rolls into a new month, you'll have a major gap, like 30 points, 50 points between the 2 months. Those gaps are insignificant. They add extra premium that really shouldn't technically be there, okay? So by looking at the cash index, which is SPX or US 500, whatever floats your boat, you won't have those insignificant gaps that are adding, worthless premium to the instrument, okay? So now that that's aside, basically what I'm saying, in the very, very near term, the S&P has been very resilient, okay? Last week, 2 different newsprints occurred, right, that should have produced a pullback. CPI came in hotter than expected on both the headline print and the core print, and 2 Fed officials pushed back on the idea of a March rate cut. Those should have produced a pullback because that is hawkish news, right? That is bearish news for the market. However, the fact that the market, the S&P 500, managed to close the weekly candle green and stay very resilient over the last 2 weeks, right? And the fact that it's 1% away from the previous all-time high that was made over a year ago, that makes Dylan believe that previous all-time high is going to get broken above, in plain English. In fact, I'd be surprised if it didn't in the near term. And like I said, when I say near term, I'm talking month and a half, okay? So that's where I'm leaning towards in the very near term, okay? Going further down the timeline, past the near term, right? Now we're talking, call it, March, April, May, okay? There's one big thing that is very concerning, okay? And what that is the gap. There's a large gap between what the Fed has been saying and what the market thinks, okay? Hear me out. kind of talked about this last week's video, but I'm going to kind of go more into it, okay? So right now, the market expectation is that the Fed is going to cut rates 6 times in 2024. Okay, that is what's being priced into the market, and that is why the market managed to rally in such a large caliber. Okay, the market is expecting the Fed to cut 6 times in 2024. That's like Dylan O'Neill saying that I'm going to have a 6-pack in 3 months. Is it possible? Yes. Is it likely? Probably not, whether I like it or not. Okay? Now, 6 rate cuts in 1 year is very significant. Okay? Basically, it allows very, very, very small margin for error in plain English. Okay? So, with me saying this, we're going to have to look very closely at data. Okay, data going forward, right? What does the Fed say when they talk about their future path in terms of, cutting rates, right? That's what's going to be the largest risk factor to the market. Because if the market does not, in fact, cut rates 6 times in 2024, it's going to set up for a large pullback, because essentially the assumption of that happening that caused this major rally is going to be proven incorrect. Okay, so with that said, we're going to hop into the schedule for the 2024 FOMC meetings. Okay, that 6 rate cut path that the market is anticipating implies that the market is going to start in March. Okay, that's what the Bloomberg WIRP page implies. Okay, this is public information. So let's just say hypothetically that happens. March we cut, April we cut, June cut, July cut, September cut, November cut. That's 6 right there. If that occurs, the market will have a way better ability to sustain value and, potentially even rally higher, based on other factors such as earnings, right? If we get, really optimistic earnings and inflation really starts to come down and continues to come down and so on and so forth, right? That will give the market the best ability to continue its rally, in plain English. If the market, or if the Fed does not cut 6 times, right, they cut less than what the market is expecting, that sets the S&P up for a larger pullback, right? So going into, March, April, May, it's going to be so important to watch what the Fed says that it's going to do, okay? So I'm going to come up with another hypothetical scenario. Let's say in March, when people think the first rate cut is going to occur, it does not occur, okay? Technically, that path of 6 rate cuts is still intact, because then the Fed can cut rates in April, June, July, or September, November, and December. That's 6. Okay, so technically, if March does not occur, I do believe that it will produce a pullback. Let's call 3 to 5% pullback, right? And where would that take the S&P? Let's just say, if my expectations are right. 3 to 5% pullback, let's call it 4 to be in the middle. That's not bad, okay? However, if the market, or if the Fed does not cut in March and May, then I'm looking for like a freaking 10% or more. I would not be surprised if the market then comes off 10% or more. Okay, so that's why the timing, right? The timing all relies on what the Fed says they're going to do, right? And what the market prices in. Okay, so that's very, very, very important. Okay, so I'm going to be talking about this more and more as time progresses, but I just wanted to show you guys, what it looks like now so that you can kind of prepare yourself for the future, okay? So like I said, near term, I would be surprised if the market did not break above previous all-time highs. Okay, going, way more near term, the market has been in a consolidation range for like the last month. Okay, and the tighter one has been for the last week, right, from last Tuesday to today, which is Tuesday, right? So going, very, very short term, the S&P has been respecting this trend line, right? It's tested 3 times in the last week. If this breaks below, you can technically get a, further pullback back into this area where the wicks were created, right? Where this rally from last week, kind of initiated. Okay, so if this trend line breaches, and the VIX picks up, and volatility increases, I would not be surprised if we get a sell-off down into this region. Okay, on the flip side, you have a NASDAQ level that has continued to get defended by the bears, right, in the very near term. You want to see NASDAQ break above this recent resistance because it has been the market leader, right? The leading instrument has been the NASDAQ, and as a result, you want to see the leading instrument lead the sentiment in the market. So if NASDAQ manages to break above 17,040 and then manages to hold above that, and the bulls start to defend that area as prices above, and they start to defend dips above that, that's a good sign from the bulls. Okay, so in the very, very near term, look at those two extremes: S&P support, and then NASDAQ resistance. Okay, and then my key areas that we went over in last week's video, in case the market does happen to really start to pull back, those areas are still intact because they have not hit yet. So on the NASDAQ, we have the anchored VWAP from the October 2023 lows, which also line up with the 50% fib using this area of consolidation, right? So this general area right here should technically act as support, which is right around 16,150. And then also that area should also line up with the S&P retest of this general consolidation before the rally started, which is right around 4630. So if the market does in fact manage to really, pull back, 3.5% to the downside, those would be my areas to look at for, potential dip buying. So those still stand. Okay, so that's it for this video. Hopefully the everything made sense. If not, feel free to drop a comment below. And as always, feedback is very appreciated. Peace.